When you adopt the new lease standard, there are some key accounting policy decisions you will need to consider. Hi, I'm Priya Singleton, Quality Control Officer at Blue & Company. Once you've selected the initial application date and practical expedients available to you when you transition to the new lease standard, it's time to select accounting policy elections. The first election is the short-term lease exemption. The lease standard defines a short-term lease as a lease that at commencement date has a lease term of 12 months or less and does not include an option to purchase the underlying asset that the lessee is reasonably certain to exercise. If this exemption is elected, you do not have to capitalize your short-term leases on your balance sheet. You can simply continue to treat them as operating leases under ASC 840 and recognize the lease cost on a straight-line basis over the lease term. This exemption can be elected by asset classes, like equipment leases, but not a lease for office space. For one-year leases containing renewal options, where you have determined at the commencement of the lease that the renewal is reasonably certain, this does not qualify as a short-term lease. Electing this practical expedient could save you time and lower your overall lease liability. However, keep in mind that even though you will not be recording the short-term leases on your balance sheet, you will still need to disclose the short-term leases and their annual expense in the notes to your financial statements. The second election to consider is whether to combine your lease and non-lease components. The lease component is any payment you make for the right to use the asset in your lease, such as equipment, while the non-lease component generally represents payment for a service you're receiving, such as maintenance. Under the lease guidance, you're required to allocate the consideration in the lease contract to lease and non-lease components. Only the portion of consideration allocated to the lease component will be included in the lease payments, while consideration for non-lease components are excluded. This essentially requires you to perform an analysis to determine the proper allocation between lease and non-lease component for every single lease contract, which can be a huge effort. By making this election, you can combine the lease and non-lease components and account for it as a single lease component, saving you the hassle of performing the tedious analysis. But be aware that by electing this option, you'll be capitalizing more cost on the balance sheet. You could potentially even be triggering a finance lease treatment because including the non-lease component in the lease calculation could push you over the threshold of greater than substantially all of the fair market value. And it may even trigger an impairment because the value of your right-of-use asset may end up being greater than the market value of the asset. We still think companies will want to make this election, at least for certain classes of assets like real estate leases. Just keep in mind that if you elect the exemption, it should be applied to all relevant non-lease components. The third practical expedient is related to discount rates, but it is only available to private companies. The discount rate is a key input that impacts both lease classification and lease measurement. Under the lease standard, you're required to use the discount rate implicit in the lease contract. But since that rate is typically not available, lessees are required to use their incremental borrowing rate. Determining the incremental borrowing rate under ASC 842 can be a complex process. Instead, this practical expedient allows lessees to use the risk-free rate, which is much simpler and more straightforward to determine. So what's the catch here? Well, the risk-free rate is typically very low, which will result in a lease liability and right-of-use asset that is larger than those that would be calculated using the incremental borrowing rate. Using the risk-free rate could also result in a present value calculation that may exceed substantially all of the fair value of the underlying asset, causing the lease to be classified as a finance lease rather than an operating lease. If you'd like to understand more on the implications of making these elections, please click on the link below and download Blue & Company's ASC 842 Lessee Implementation Guide.